the recording button here, and then also getting this onto the proper platform to make sure that we have everybody in the closed Facebook group that wants to join us can do that as well. So 1 second here. Let's see. The name of this episode, as you can see, or episode, I'm thinking about podcasts is what I'm thinking about, Marco. I'm sure you've done that before too. After you do a couple of episodes on your podcast, you kind of get into that mode.
Oh, yeah.
How to invest out of state. I'm going to tag you in that. All right, so we should be good here. Let me do an introduction of you, Marco, and we will get this started. Let's see. All right, this is Marco Santarelli. This is our 5 p.m. Eastern. This is the last session of the day, and then we will be back tomorrow morning with opening remarks at 7:45, along with me opening up on a keynote at 8:15, and the 8:15 keynote will be only in room 1. There will be no room 2, so make sure you attend that. I promise you will enjoy it. It is going to be about working with investors and investor relationships and how to really make the best use out of the high net worth individual's mindset. So we're going to go through that tomorrow, and we'll talk a little bit more about that after Marco's session. But Marco's an investor, he's an author, and he's also the founder of Narada. Did I say that correct? Narada?
Narada, sure. Yep, that works.
Narada Real Estate Investments. It's a nationwide provider of turnkey cash flow investment properties. And since 2004, they've helped thousands of real estate investors create wealth and passive income through real estate. He's also the host of the top-rated business podcast, Passive Real Estate Investing. Make sure you tune into his podcast. It is really a lot of good golden nuggets that are buried in there. I appreciate you having that podcast, Marco, as well. I'm going to turn it over to you, let you take it over. I will be in the back end in case you need me for anything, but my mic and camera will be off. And as the questions come in at the end, I will tee it up for you to be able to answer those questions, and we will go from there.
Sounds great, Dan. I appreciate the introduction, and thanks for allowing me the opportunity to share what I'm going to share today with your audience. I'm pretty excited about this presentation. It's something I talk about pretty frequently across the U.S., and that is really how to invest out of state. And I almost want to say that this is long-distance real estate investing, which is somewhat foreign to some people, and it shouldn't be, because really it's something I've done for many, many years, back as far as 2003, and it's really the greatest way to find the best opportunities and invest properly. And I'm going to get into that today, but I really want to share with everyone how I did it, how you can do it, what to look for, what is the formula, if you want to put it that way, and the process. And it's really not complicated. It's really just a matter of understanding how it works and the way that you can utilize this process and build your team and look for the right things to present the right opportunities to you. So let's talk about how to invest out of state, because that is really something that we do personally as investors ourselves and as a business. So let me quickly begin by just sharing with everyone a little bit about myself. I'm just going to take half a minute or a minute here and tell you who I am. For those of you who don't know me, I am first and foremost an investor, specifically a real estate investor, but I invest in many different types of asset classes. And I like to study the subject so I can talk about the different types of assets, their pros and cons, and I'll share a little bit of that with everybody today. But I'm also an author. I've authored many articles, different reports, guides, and I've written a book that is being published here real soon called Passive Real Estate Investing, and it's named after my podcast of Passive Real Estate Investing. I also founded Narada Real Estate Investments back in 2003, 2004, and my company is essentially a nationwide provider of completely turnkey cash flowing investment properties. We're currently in 22 markets there, so I keep dibs on about 404 markets around the U.S. to keep track of what they're doing in terms of growth, appreciation, profit potential in terms of cash flow, and overall rates of return. So I bought my first property when I was 18 years old. As soon as I could qualify for financing, I just jumped in. I bought my first townhome. I renovated that property. I leased it, managed it myself. I did not take a course or read a book. It was just kind of observation and a lot of thinking it through. And, maybe I got lucky, but it was pretty much textbook. And I did have a small team around me, but they were really support, not so much guidance. But from there, the writing was on the wall. And as years went by, I basically built a large portfolio. In fact, in 2004, in less than a year, in fact, it was about eight or 9 months, I acquired 84 doors. And those were mostly single families, duplexes, and fourplexes. There were a couple of small apartment complexes in that mix, but 84 doors in less than a year is really when I decided to do this full time and hit the ground running. But the important thing to understand is I was living in Southern California, and I still live in Southern California. In fact, it's a crazy rainy day, if you can see that behind me here. But I did this from 1,500 to 3,000 miles away in acquiring these properties. And many of them still to this day, I have never seen with my own eyes. It was all done through my team and over the internet. And, that's some of the stuff I'm going to be sharing with you today. So it doesn't matter whether it's a single family home, duplex, fourplex, or a multi-unit property. You can do all of this remotely, especially if you are busy and have a full-time job or career and a full-time family. So there are ways to do this. Last but not least, I'm the host of the Passive Real Estate Investing podcast. It is going on 3.5, 4 years now. It is basically a weekly show. We talk about anything and everything related to real estate investing, mostly on the passive side. So whether it be buy and hold or syndications or even notes, but the taxes and the strategies and all that good stuff. And it is a top ranked and top rated podcast. So feel free to go to the website and check that out. Enough about me. This is a quick shot of my family. This is years ago when my daughter was a little bit younger, but this was us all wearing a little bit of red for Chinese New Year at the Bellagio in Las Vegas. So I'm going to ask you a question. I'm not going to tell you the answer. Some of you might know the answer to this question as I answer it. But my question to you is, answer this quickly. Ignorance is blank. Most people would say ignorance is bliss because that's what we hear other people say. The truth of the matter is that, in my opinion and in my world, ignorance is expensive. You see, there's an opportunity cost to lack of knowledge. You don't know what you don't know, and what you don't know often can and will cost you money. And so if you stop to think about it, a lack of knowledge or lack of education is really affecting how fast you can grow and what you can achieve. Knowledge, as I say, is the new currency. And without it, you're really doomed to follow other people's advice without knowing if it's good or bad. Knowledge will help make you a great investor. It'll take you from being a good investor to becoming a great investor. And that knowledge will help provide a passive stream of income and wealth creation, not just for you, but your family and your generations and their generations and so on. So just try to remember this little 3-word sentence. Ignorance is expensive, and that's my food for thought for today. So I'm just going to go through this particular slide quickly because a lot of you listening understand why you should invest in real estate, but I'm going to highlight a few things that a lot of people don't know about or don't think about. Actually, just hold on a sec here. I'm getting some messages coming in. Maybe I don't need to. Oh, cool. Thanks. Yeah, ignorance is risk as well. That's definitely, I like that. I'm going to adopt that if you guys don't mind. Thank you, Greg. And thanks to everybody saying great content. So let me move on with that beautiful motivation. So why invest in real estate? Just a couple of high-level points here. The Wall Street Journal indicated recently that a startling 95% of Americans are going to have financial difficulties by retirement. That is a sad, sad statement. The truth of the matter is that by age 65, 54% of people will be, by definition, broke. 41% of those people will still be working. And I don't know where you guys live, but if you look around, especially in Southern California near the coast where I live here, being an expensive market, we can see this in places like Starbucks. where your barista is, interestingly enough, in their 50s, 60s, and sometimes even more. Even the office building I'm in here, some of the support staff downstairs, surprisingly, are in their 70s. So I don't know if that's by choice or by necessity, but it's a change from what I used to see 20, 30 years ago. 4% of people are financially independent, meaning they're not relying on friends or family to sustain themselves and to cover their expenses. We could have a whole discussion about real estate versus any other asset or asset class like the stock market, mutual funds, savings. The reality is that real estate keeps pace with inflation better than most, if not all, different asset classes. How many millionaires do you really know? And how many of those people created or even hold their wealth that they created through, let's say, other investments or business in real estate? In fact, most of them probably do. That's what they pick and that's what they choose. If you look at the stock market or mutual funds or savings, it's either a low rate of return, high risk, a combination of both. You often have little or no control, and importantly, there are no significant tax advantages. Real estate is the most significantly tax advantaged asset class out there. Also, I will argue that it is the most historically proven asset class. So when you look at it historically, real estate has offered stronger returns than any other option. And there are people out there that will, that'll argue that the stock market is a better performer. I tend to disagree, because if you look at the entire picture of it, the tax benefits and the leverage you can get from it, and the ability that you can defer your taxes virtually indefinitely with real estate at a lower capital gains tax than trading stocks or holding stocks, there's no comparison here. When you look around the country, and like I said before, I track 404 markets. The cash flow opportunities still exist in many markets. Granted, they're tertiary markets more so than secondary or primary markets, and I'll talk about that here today. But cash flow opportunities are still pretty abundant, and that's a great thing, because we want to be acquiring a portfolio of rental properties that produce passive income. They generate a stream of income, and over time it creates wealth for us. Moving forward here, mortgage rates are still near historic lows. Some people are saying, well, rates are going up. They've been bumped up several times here in the last year. Well, yeah, that's true, but look at it in context. It's still below 7%, which is right around the historic average or norm. Not that there really should be an average or a norm when it comes to mortgage rates, because they should follow market supply and demand. But mortgage rates are still historically low. It makes sense to invest in real estate and leverage your capital because money is still cheap. And the fact that you're borrowing up to 80% of the acquisition price from other people, and it's not protected by inflation, meaning that debt you borrow, the money you borrow to acquire real estate, is being eroded away year after year because of the effects of inflation. It's actually becoming cheaper and less valuable to the bank and a discount to you. So if you don't understand that, that's something we should definitely talk about. But that's huge. We can't get away from inflation. We are in an inflationary environment, and the Federal Reserve wants to keep us in an inflationary environment. But I think they understate the amount of inflation that we actually have. They claim they want to hit a target of 2%. They say that we have 2 to 3%. I can argue and show you that in most things, we are actually in a larger inflationary environment. And depending on whose reports you look at, it can range from anywhere from 5 to 10% or even more. Two great examples of that are student loan debt and what was the other one? Oh, it'll come to me and I'll bring it up here. Last but not least, we all know, especially if you're listening to this, that real estate is the most powerful way to build wealth. So, when you factor in leverage, you can't help but to not appreciate real estate. So, medicine is higher. Yes, definitely. Healthcare, that is a huge one. Thank you, Marina. All right, so let me dispel a real estate investing myth here. I don't like it when I listen to the media, especially on TV and the radio, and they talk about real estate and the real estate market. The fact is There's no such thing as a national real estate market. You can't show it to me. You can't point to it. And it's a mistake to chalk up all the markets in the United States into this one quote unquote national real estate market. It doesn't exist. All real estate is local, and what happens in San Diego, California is different than what happens in Detroit, Michigan, and that's different than what happens in Jacksonville, Florida, and on the list goes. There are different market drivers. There are different reasons for those drivers. The housing market's different. The median price is different. Everything's different. So yes, there is some common fundamental common denominators, but all real estate is local. Why is that? And that's because every market, even sub-market, has its own political environment, its own politics. It has its own economy. There are different business drivers. There are different employers, different types of employment, which are bringing in different types of people. And of course, local supply and demand factors. We're seeing tight real estate markets across the country. Atlanta is the first market that comes to mind. We've been in Atlanta for many, many years. It's a perennial market, but lately, last few years, we've had a hard time getting good inventory there. Inventory, period. So supply and demand also affects real estate in terms of what's available, who can afford it, who comes in, who buys, and who rents. So with all that said, the fact is that your local market where you live, especially if you live in a coastal market, it may not be the best place to invest. I'm near the coast here in Southern California. It's very expensive. Our rents are not high enough to cover all of our expenses. And so I am forced to look elsewhere to find better deals. And so I keep looking further and further away. Unfortunately, or fortunately, however you want to look at it, I have to go as far as the Midwest, Central South, and the Southeast to find some of the best deals that I buy and that we offer as a company. So what are those market differences? So let's just touch on those. We have factors like market drivers. These are often the elements in a market that create and sustain jobs. So whatever drives a market is often employers and employment and the political environment that is driving favorable tax advantages, development zones. These are all things that create jobs and employment and bring people in. Toyota is a big employer that moved out of California and they moved to Texas because it was a more favorable environment, lower taxes, cheaper housing, and they were able to produce the same product at a lower cost because they could cut their overhead. Every market has a cycle. We call it the real estate cycle. It's not the same as the economic cycle. But when you look at market cycles, every market has a peak and a trough, and the speed and rate and length of time that they appreciate and depreciate varies because of those market drivers. But these are things that you can follow. Real estate is forgiving because time is on your side. It doesn't move quickly. And so you can see what is happening. You can see what has happened historically in the past, but you can also see what is happening today. And you can make some predictions based on the various facts that you can stitch together of what is going to happen over the next 6 months, 12 months, or even 2 years. And so these are things that we do when we analyze markets. Of course, every market has its own median price. Every market is going to have its own median rent. And these are two major factors in something that I'll share with you in terms of doing an analysis on a market. Property taxes obviously vary considerably from state to state. Affordability are tied to the median price as well as the rent, but mostly the median price. What can people afford? And that's also driven by what people make in terms of their median income. And last but not least is something I call the RV, or rent to value ratio. Sometimes it's referred to as a rent to price ratio. But if you look at or take the median price in a market or a submarket or a neighborhood, and you divide that by the monthly rent, the median rent of that area, you come up with a rent to value ratio. And this is expressed in terms of a percentage. And I'll give you a quick example because we're going to talk about this more later in examples. But let's just call it the $100,000 home. Let's just say it's a 3-bedroom home, costs $100,000. You can rent it for $1,000 a month. That $1,000 monthly rent divided into the $100,000 acquisition or purchase price is 1%. That is an ideal target for what we like to invest in, what we advise our clients invest in. If it's a little lower than that, like 0.9, 0.8%, that's fine. That'll still work, especially if you have other factors like appreciation potential in that particular market. The higher that number, the better. But just be careful, because when you start to get into lower quality neighborhoods or sketchy areas, that RV ratio does go up, but it's at a cost of being in an undesirable neighborhood that probably has low or no appreciation potential. So the ideal is to be in a good neighborhood with our RV or rent to value ratio that is around 1% plus or minus. And again, this differs from market to market, neighborhood to neighborhood. All right, so what's the solution if you live in a coastal market or an expensive market or an area where the numbers don't make sense in your backyard and you can't go out 1 or 2 miles and find something that's favorable? And these so-called gurus, quote unquote, they often talk about or advise that you invest within a driving radius of your house, an hour, maybe 2 hours. That's bad advice, especially if you live in a very expensive area or in a very bad area to invest in. The solution is simple. Invest in the best markets that you can find that produce the best overall returns. And that's what we're talking about here. So let's move forward. Investing locally versus other markets. I'm just going to touch on a few things here that, that are what people think about when they think about investing locally versus other markets. So in terms of investing locally, obviously it has a comfort level. You're familiar with your neighborhood. You're familiar with your market. So it's got a warm, fuzzy feeling in your belly when you know and understand your local market. That doesn't mean you can't learn as much as you know, if not more, about your market in other markets. The information is there and it's widely available on the internet. So keep that in mind, that we have this amazing tool called the internet, and there are so many websites that have tons and tons of free available information that you should be able to do your due diligence all the time. A lot of people are do-it-yourselfers. They like to get their hands dirty. They roll up their sleeves, swing hammers. If that's what you're looking to do, is renovate homes. I don't want to do that. I've done a lot of it, but I don't want to be that type of active investor. I want to be a passive investor. And that's why I titled my podcast Passive Real Estate Investing, is because I want to buy and acquire real estate. I want to benefit from the cash flow. I want to benefit from the appreciation, but I don't want to be doing it all myself. I just want to be the CEO of my company, have a team around me, including my property managers, and have them manage the properties. And they just report back to me. And every month I get a check. Actually, I don't get a check anymore. It's all ACH. It's electronically deposited into accounts. So, but they used to call it check in the mail, the check's in the mail, but now it's just, deposit in the bank account. And investing locally gives you more quote unquote control, but is that really true? I think often this is just a figment of your imagination. You really don't have more control if the property's 30 minutes away or 300 miles away. The fact is that you're going to have a team that's going to manage your property and take care of all the things that need to be taken care of. But the big thing here is that you don't always find the best deals locally. If you were investing in the stock market because you wanted to, and you had to choose a stock, would you choose a stock that in a company that is in your local market? Coca-Cola comes to mind. Coca-Cola is based out of Atlanta. Do you need to live in Atlanta in order to invest in Coca-Cola? No, you could live in Southern California or New York or wherever you want and still invest in Coca-Cola if you think Coca-Cola is the best deal going. So just remember that you need to be market agnostic. It's one of my 10 rules of successful real estate investing, which you can find on our website. Those 10 rules really are a great guide to keep you focused and on track and be objective, not emotional about your investing decisions. So always invest in the best deals because you want your capital, your money, to work as hard as possible for you. So compare that to investing in other markets. Often, depending on where you live, you will have better cash flow, therefore better returns and better upside potential if you know how to pick the markets. We are currently in 22 markets for different reasons. Some are heavily cash flow, some of them are heavily appreciation or growth based. And so, we have those as our targets. Stable equity growth is a key thing. And that's not true in every market, but you want markets to have stability. They're stabilized markets and they have equity appreciation potential, so they have that stable equity growth. You don't have a lot of downside risk as you find in the cyclical markets like the coastal markets. And I like to say lower risk because I like to pick markets that have lower risk. There's no such thing as an investment that has no risk, but often it's more about you as an investor that determines the amount of risk in an investment, not so much what you're investing in, because there are investments that people do really well in and other people fail at because they don't understand the investment. And this is why knowledge is that currency. Knowledge is important. Educate yourself and also have the right team around you. All right, so quickly, for macroeconomic factors you want to consider. Selecting a market, there's 4 factors here that we look at and that I talk about, and really let's just kind of fly through them, but they are important. Okay, so number 1, stable versus volatile markets. Basically, internally we call these linear markets and cyclical markets. You typically find cyclical markets in the coastal markets of the United States. They are sometimes referred to as bubble markets. They appreciate rapidly and they depreciate rapidly as well. Sometimes they depreciate faster than they actually appreciate, and that's the downside risk that you see in these high land value markets like coastal California. I like to be in stable markets, those that are more stable in terms of the volatility of price over time. And you can just look at a chart of 10 or 20 years of prices in a market to see what that looks like. But every market will have its own bump, and those are often driven by economic factors or employers coming into an area. When you have, oil is a big factor. If you looked at, North Dakota, when we had that oil boom, oil prices were very high. People were flocking there because there were a lot of high-paying jobs, but the problem is there was no housing. So there was a shortage, and a lot of builders came in. They started building homes as quickly as they could, and it drove the real estate market through the roof. But the problem there was it got to the point where the job market dried up because oil prices crashed, and now all of a sudden you had all this inventory built and inventory being built that flooded the market with an excess inventory, and you had this market crash. So you don't want to be in these types of markets. And so stable markets are typically second-tier markets, sometimes tertiary markets, the smaller markets surrounding these secondary markets that have had and shown long-term stability. Number 2 is diverse metropolitan area. What we want to see are, we want to see a stable economy surrounded by a diverse job market. We want to see jobs in different industries, from healthcare to construction, manufacturing, finance, whatever it may be. You want to see that kind of stuff to add to the stability of that market and provide diversity. Because if you have a lot of jobs spread across different industries, you have a large rental pool of tenants that will have a need for rental housing. Not everybody buys, but they add to the rental pool. And the rental pool is what you need as a landlord or as an investor, regardless of whether it's an apartment complex, a fourplex, or a single-family home. So diverse metropolitan areas. We talked about the rent-to-value ratio, or that RV ratio, and this is an important thing to keep in mind because you want to try to be around that 1%. If you get into some really sketchy areas, what I call the CC minus D-class neighborhoods, that number will be a beautiful but deceiving 2% or higher. Unfortunately, that's just a recipe for disaster. So I've seen so many deals, and I've seen so many investors invest in all kinds of things over the years, and I've made the mistakes. I've seen other people make mistakes. Try to just stay around that 1% RV ratio. Buy the best deal you could possibly find, but keep the bigger picture in mind. Lastly, landlord-friendly states. There are certain states around the U.S. that are certainly more favorable to you as a landlord. The cards or the deck is stacked in your favor. They don't help the tenant out if there's an issue, or they want to be what I call a quote-unquote professional tenant, where they can game the system, stop paying rent, and be able to sit in that house for 6, 9, 12 months at a time. You don't want that. You want to be in markets and states where if and when you have to do an eviction or serve a notice, that you have the system stacked in your favor to move those tenants out as quickly as possible and as easily as possible, because you need to turn that property over, get a new paying tenant in there. I'm giving you worst case scenario here, of course. I mean, this happens, but not all that often. So, but it's just always good to be in a state like Alabama or Texas or Arkansas, where it's very, very favorable for a landlord, as opposed to some of the more what I'll call, not to sound political, but obviously they're leftist or democratic type states like New York, California. Our laws here are very much favored and stacked towards the tenants here. Okay, so big picture, 3 kinds of markets. We've touched upon this, but a quick review. First and foremost, we have cash flow markets. Examples include Birmingham, Alabama, Huntsville, Alabama, Memphis, Tennessee. There are others. Many of these are on our website. These are markets that are very linear in nature. They don't appreciate rapidly, and they typically don't have above norms or above average appreciation rates. So they just keep up with inflation, maybe a little bit better. But they offer good rent to value ratios. Therefore, they provide good cash flow in dollar terms. They provide good cash on cash returns when you look at it from how much do you make per year net versus your investment capital. That's what I call a cash flow market. Second is a growth market. A growth market has strong appreciation potential. You typically would invest in a market like this because you expect the next 1 to 3, maybe the next 1 to 5 years to be above average appreciation. So they don't typically give you as much cash flow, and your rates of return, like your cap rate, your capitalization rate, and your cash on cash return are going to be lower. Hopefully I'm not going too fast, but just understand that there's a give and take here. When you have higher cash flow and higher cash on cash returns, often, not always, you tend to have lower growth potential, therefore lower appreciation rates, at least in the short and medium term. But Atlanta and Dallas in the last 3-4 years have been very strong growth markets. We saw it coming, it's happened, and it's continuing to go on. But that just means that many of us have missed the boat in buying, at an ideal time where we get great cash flow. Houston and San Antonio are also following in Dallas's footsteps as being a strong appreciating market. But then there's a third type of market, which is kind of a combination of the two, and that's what we refer to as a hybrid market. And currently, those are markets like Indianapolis, Chicago, Jacksonville, Florida, Kansas City, Missouri. Here we're seeing, on average, appreciation rates between 5 and 10%. It kind of changes based on sub-market neighborhood and the time of year that you're measuring this in. But these are markets that offer positive cash flow, a good cash on cash return, and a very attractive appreciation rate. Now, I don't buy based on appreciation. I always make sure that I have a good neighborhood and good cash flow, and that I have appreciation potential, which makes it more or less a hybrid market. But I don't buy to speculate. I'm not a gambler. I don't speculate. I don't advise anybody do that. But you have to understand that you can get the best of both worlds. You just have to decide where you fit on the spectrum. So moving forward here, in fact, why is it going in the wrong direction? So those were macroeconomic factors. Let's look at microeconomic factors. This is where we really start to sink our teeth into the location within a market after we've chosen a market. And I break this down into three neighborhood types. You could all argue that there's 4, maybe 5, but I just call them A, B, and C. D to me is the sketchiest of the sketchiest areas. Some people refer to them as war zones, and I don't even go anywhere near there. But I'm going to start with a C-class neighborhood because this is a good frame of reference for what we're going to talk about in terms of A's and B's. So a C-class neighborhood is typically areas that have cheaper prices. I say cheaper because it's a relative term, say cheaper in quotes. In the markets that we're in, the 22 markets that my company is in with turnkey rental properties that our clients are purchasing, those are often neighborhoods where the purchase price is under $70,000, $75,000. Again, this is going to change. It's going to be different in Birmingham, Alabama. A C-class neighborhood is different in Birmingham, Alabama, as it will be in Dallas, as it will be in, let's say, Indianapolis. So these are just frames of reference for you, it's not a hard and fast number, but they have cheaper prices. They have higher rent to value ratios, which means that price compared to the monthly rent is going to be lower. You have a higher RV ratio. That means you are going to have a higher cap rate and a higher cash on cash return. I'm going to leave it there because I'm going to paint this picture a little bit more here in a minute. They look great on paper. Why? Because they have a high RV ratio. They have what looks like a really good cash flow. They look like they have good numbers on paper. And for the most part, that's true. But here's the problem, is we're not taking into consideration future growth potential. So a lot of investors are mesmerized by deals that look good on paper, and they say, hey, that's a great deal, I'm going to buy it. And many times it works out for them. But again, you need to consider the bigger picture of where that deal is going to go. And we're going to compare that to the B's and A's here in a minute. The problem I have with C-class neighborhoods is often they have higher turnover. I got to be careful in what I say here, but if you look at the demographics and the types of people that live in these middle low to low income areas, what I refer to as C-class neighborhoods, you have people who are just generally speaking more transient. They change jobs and lose jobs more frequently. They don't make a high income. They don't have that stability, and so you have that higher turnover. And because you have higher turnover, you tend to have higher vacancies. The most expensive thing with a rental property or any income property period is the turnover. A turnover can basically cost you 2 months worth of rent. And if there are repairs, it eats up your cash flow for that year, or maybe more. And that's the thing I don't like about C-class neighborhoods. I'm not saying you shouldn't invest in C-class neighborhoods. The thing is don't build your portfolio only with C-class neighborhood properties, or don't necessarily start there unless you have thick skin. Build a stable portfolio in A's or B's, and then add the C's just for that higher cash on cash return if you want it. Last but not least, C-class neighborhoods will tend to have financing issues. Here's why. Because property values or property prices are going to be in the $40,000, $50,000, $60,000 price range, they are not high enough for a lender to want to lend on those properties. Lenders don't like to do loans that are below $50,000, maybe $60,000. If it's less than that, they just won't do it. It's not worth their time. And so it may be hard to get financing in these areas. So it becomes an all-cash purchase. I like to finance my real estate. It's one of the benefits of real estate. So I like to go and get 80%, 75% financing from a lending institution. Now let's talk about A-class neighborhoods to compare. Again, within the range of markets that we're in, A-class neighborhoods tend to be, I need to bump this number up a little bit, maybe to 140, 150,000, but they're higher priced homes. They're often going to be $130,000 to $150,000 and up. Now, often you're going to find A-plus neighborhoods in the $200,000 to $300,000 range, but they kind of start in many of the markets we're in around the 130 to 150 price range. And there's nothing wrong with that as long as you have the right rent to value ratio, but that's the give and the take. They do have a lower rent to value or rent to price ratio. So it doesn't look quite as attractive. They don't look as good on paper, as I like to say. But the reality is they have a better demographic, anecdotally speaking, a better quality type of tenant, meaning you have lower turnover, lower vacancy. And here's the great thing, very few financing issues because you'll have a lot of comparable sales, a lot of sales comps to support the appraisal that will give you the value, assuming it's priced correctly. And so we have very few appraisal issues. And we like that because we want the transaction to go smooth. Now, if we look at what's in between an A and a B class neighborhood, we have what we call, or between an A and a C, we have the B class neighborhoods. And these are like hybrid markets. It's a good middle ground. They tend to range around the $80,000-ish to $130,000, $140,000 price range. And I'm talking, a turnkey or good quality, no deferred maintenance type of property right now, not a fixer-upper. So that's the range. And so they have moderate price or rent to price or rent to value ratios. Those are going to fall in the 0.8, 0.9, maybe the 1% range. That's not uncommon. The the markets have appreciated across the country so much that we've seen those RV ratios drop lately, actually over the last few years, but they still have moderate ratios, which is good. But they look good on paper. They look good on paper basically across the board, which is a nice thing about the B plus type neighborhoods. As a side note, the bulk of what we actually sell to clients, in other words, what clients choose that fits their investment criteria, actually are B plus and A minus type properties. So that's the bulk if you looked at a bell curve. And as you go further out on either side, it's fewer and fewer. Lower turnover, relatively low turnover, and low vacancy, because again, you've got your middle income, middle class type of demographic and tenant, and that makes up really middle America. It's the majority of the U.S. population live in these B class neighborhoods, and they're still easy to finance because there are still a lot of comps. It is a combination of a retail market and a rental market, so you get the best of both worlds. Now, someone asked, are you talking about single family or multifamily? It's actually both. This applies to both, because in a lot of these neighborhoods, you will find multi-unit properties. But whether you're looking at a single family duplex or fourplex or a 50-unit apartment complex, you can break all of these numbers down into a per unit basis. And so when you do that, you're really looking at it granularly, at the most basic element or building block of a rental property. I hope that made sense. So here's my personal qualifier. When I'm looking at a neighborhood personally as an investment, if there's no retail buyer in that area or that market, I don't buy it. I mean, it's that simple, because I want to know that I have an exit strategy if and when I need to sell that property. I want to know that there are other buyers interested in that neighborhood and that area to purchase that property. So I want to know that there are sales comps and there are retail buyers for those properties in the area I'm looking at. Otherwise, I am not going to bother. And if I had to map this over to a letter grade, I'm going to say that mostly C's and definitely D class neighborhoods are areas where there are few to virtually no retail buyers. So again, just a rule of thumb, but it's a personal qualifier. Let's look at some quick examples. There's going to be a lot of numbers and rows and columns here in a minute. Don't get lost. I'm going to have you focused on 3 specific things in what I'm going to show you. So these are actual deals or actual properties that we've sold to our clients through our network and through our investment counselors. Here's one in Birmingham. It was about $75,000. This was last year. The rental income, $850 per month. So that if you do the math, divide the $850 to $75,000, it's 1.1% rent to value ratio, a very, very attractive number. This is a 3-bedroom, 2-bath home, a little older, built in the 60s, but it's a B plus neighborhood. So that's just a quick profile of what this property is. It's a cash flow market. So here's what I'm going to show you. Don't let your eyes glaze over. This is really a screenshot off of our website. Every single property on our website has this detailed and customizable cash flow calculator that you can use. You can actually change all the numbers and create your own scenarios, but it's populated with the actual numbers of the property. But I want you to just look at 3 things, the areas that I've highlighted in orange. Your cash flow, whether annual or monthly, is broken down. I like to look at years 1 and 2. Year 1 usually being the actual numbers of what the property is doing right now, because most of these properties are leased. But looking at years 2 and 3 give me a quick snapshot of what I expect to see in the near term, and then years 4 and 5 give me a snapshot of what I expect to see in the medium term. So I don't just base my decision on year 1. I look at what am I going to see over the next 3 to 5 years. But there's 3 things I look at. The cash flow, and these are net numbers. What I mean by that is you want to deduct the vacancy allowance to be conservative, and you want to budget for that, and you want to budget for maintenance reserves. Again, you want to be conservative and budget that in. Typically, we budget 5% for both, but you can lower that and you can increase that. So this gives you a more conservative number and maybe a more realistic number, but often these numbers are higher than what you see here. So as you see appreciation, you will see that grow over time. I don't want to put a lot of focus on that, but we love net worth and wealth growth, and we like to see that equity grow, because then you could leverage that equity and move it into growing a larger portfolio, which is a strategy that we employ with our clients, and that does grow over time. But it's the bottom that I want to just focus on real quick. The cash on cash return is just calculated based on what you expect to net on that property, based on how much you've invested. This is a key number. I don't like to look at the cap rate or the capitalization rate, because I feel it's very one-dimensional, and it doesn't give you a true picture of all the benefits of real estate. So cash on cash is one step up from that. Your total ROI, or return on investment, factors in everything: the appreciation, the amortization of the loan, so the equity growth, plus the cash flows from that property into whatever you've invested. So that is a more holistic number, and it's really the snapshot of the return on all the benefits of that real estate, not necessarily including the tax benefits, because you can defer most or all your taxes if you have a good CPA and they're doing the, they're handling the depreciation on these properties correctly. But I'm going to show you one more thing here. If you were to take a 5-year rate of return on this thing, something we refer to as the IRR, or the internal rate of return, and say, and determine what was your rate of return over the course of 5 years. On this property, it works out to be just over 20% per year over a 5-year period in terms of an internal rate of return. That is great. It's outstanding. And it's really hard to compare any other investment or investment class to real estate because of that. So let's look at another example. Now, this was a cash flow market example. The next one I'm going to show you here is a hybrid market. It's kind of a cross between cash flow and growth, a little lower on the cash flow, a little higher on the growth potential. This is a property from about a year ago, Lakeshore Drive in Kansas City, 145,000. This is an A- type neighborhood. Leases it leased for 1,400. I think it's actually at 1,500 today, but it's about a 1% RV ratio. 3-bedroom, 2-bath. Again, it's built in the 60s. A lot of these renovated properties are going to be from the 60s and 70s. It's just the housing stock in the U.S. But here's a quick look at the 5-year numbers, both actual in year one and pro forma. So again, we've got cash flow that's in the 200 net of all expenses per month, so over 3,000 per year. Strong appreciation potential. I don't remember what this actually did. I think we had forecasted it at 5%, and it actually produced about a 7% appreciation rate. So the cash on cash return is a little over 9% net, using net numbers. So we are being conservative here. But I don't want people to just be focused on the cap rate or the cash on cash. You have to look at this holistically. So if you look at what it actually did in terms of appreciation, and you take that appreciation or equity growth from amortization and appreciation and combine it with your cash flow from this property, and then you take that, which is what we call realized gains and unrealized gains, you combine them together, and then divide that into your investment, the actual capital outlay to acquire this property, you are very quickly in the 40 and 50% range, which is outstanding. And so if we took a 5-year sale and calculated our internal rate of return, it's a whopping 33%. It's incredible. And I'm not suggesting that anybody sell their property after 5 years. You really have to look at what the market is doing and where you could better utilize your equity, if that makes sense. And then we can talk about doing a tax deferred exchange, what's called a 1031 exchange. It's basically a way for you to move that equity tax-free into more property, other property, and build your portfolio, a strategy that a lot of our clients employ. We can certainly talk to you about that, or at least our investment counselors can talk to you about that. And lastly, another example, this is a growth market. This is not going to give you a lot in terms of cash flow, at least not initially, but that's not really the primary strategy of going into a growth market like this. So a lower RV ratio, 0.8%. This 4-bedroom new construction home. This was newly built not too long ago, last year, 2018. Jacksonville, Florida, for us is kind of a cross between a growth and a hybrid market. The outskirts where we're building new construction are more growth oriented. So let's look at some quick numbers here. Your cash flows are typically going to be, between 100 to 200. In fact, if you look carefully here, I put 0 for maintenance reserve. And the reason for that is because these are new construction. You really shouldn't have any kind of repairs or CapEx expenses, anything like that. You should be good for 2, 3, 5 years without having to repair or replace anything other than damage by a tenant, of course, which they may be liable and responsible for. But there is cash flow, but there's strong appreciation potential. We are seeing it, and we expect to see it for the next 1 to 2 years. It's hard to predict beyond 2 years, but we can see through tools that we have what is going on in the market and the momentum in that market, and we can predict quite accurately for the next 2 years what it'll do. But because of that, we see higher appreciation. And so even though you have a lower cap rate, lower cash on cash return, and not a super sexy cash flow, if you had this as a 3 to 5 year hold, you can get a lot of gain in terms of appreciation and then do a 1031 exchange into other property, probably in other markets. But again, when you look at it from an internal rate of return perspective, as if you had sold this in 3, 5, 7 years, you will see that, as you weather through that hold period, you have a very high internal rate of return, and that's pretty exciting to me. So I can give example after example. Here's the process that I started doing back in 03, 04, investing from California, 3,000 miles away, in other markets from as far south as Southwest Florida to as far north as Michigan. So in just real general terms, and this is, believe it or not, always ends up sounding like common sense, I always like to say, start off by defining what it is you're trying to achieve. What are your goals? Define them clearly, write them down, break that into a criteria. Where do you want to invest? What type of market? Why? What numbers are you trying to achieve? In other words, create a buy box. It doesn't have to be a specific number. It could be a range, but just create yourself essentially what we refer to as a buy box. And anything you look at and do your due diligence on is going to be something that fits inside that buy box, that criteria you've defined. So once you've done that, then you can start analyzing the markets that meet that criteria, that fit that buy box criteria. And those might be linear markets, they might be hybrid markets. In other words, they might be the cash flow markets, they might be the growth markets, they might be the hybrid markets in between. But you want to define 1 to 3 markets that will meet your needs. Of course, all of this stuff that I'm telling you is the stuff we do literally every day with clients through our investment counselors here. But I'm just giving you that process so you can do it on your own. Once you've picked the markets and you've looked at jobs and job growth, those are the key things right at the heart of it all. What does the job scene look like? Has there been job growth? Is it stable or is it growing? What is predicted for the next few years in the foreseeable future? Once you've identified that market, then you can start narrowing it down to the types of submarkets or suburbs and neighborhoods. Now, you're not always going to do this by yourself. You're going to do this in combination with your team, which is the next part of this process. Assemble the right team. Whether it's a real estate agent, a real estate broker, a turnkey provider like our company here, if you're doing a lot of this hands-on, your wholesaler, your acquisition team, your property manager, and this is not or, it's and. Your inspector, your title company, your CPA, your attorney, if you're in an attorney state, a lot of states use title companies. These are the people that you have to use. And so you're going to assemble that team. You're going to do some research and due diligence and make sure you have the right people referred to you. You're going to look at their reputation, but you want the right team. This is a team sport. Real estate is all about the team. It's not about you being a solopreneur. So once you have the right team and you've picked the market, you can start looking at neighborhoods, you can start doing your due diligence, but now you can start analyzing property. You can start looking at actual properties in these neighborhoods, in these markets, start running the numbers, running the different scenarios, creating your what-if scenarios, talking to your property managers and your acquisition team to learn more about the market. And of course, throughout this whole process, you are also on the internet looking up information in terms of What's driving that market, employment, unemployment, major employers, migration trends. Is there positive migration, negative migration? These are types of things you want to look at. So you're analyzing the market, but you're also analyzing the property. And you're not just analyzing the property. You have to, again, step back and take a holistic approach and look at the entire market. So you analyze properties, you shortlist it, maybe down to one, but you shortlist it down to 2 or 3. You submit an offer, and if that's accepted, then you obviously continue doing your due diligence. But ultimately, once you've shortlisted your property, you go to contract, you do your inspection, top-down inspection with a third-party home inspector, another person on your team. You verify all the information. It's like Ronald Reagan said, trust but verify. So you've been given the information, now verify the information. If there's an HOA, not always, but sometimes there is, verify that information, make sure that there is an HOA, what are the costs, or is there anything in arrears? Do they even allow rentals? Some HOAs don't allow rentals. We've come across this problem a couple times here in the last 12 months. And so these are things that once you've done it once or twice, it becomes basically second nature. I mean, the process is just the same every single time. We've documented this. It's literally a step-by-step, check the box as you go document that our investment counselors share with our clients. Happy to share that with you as well. Just reach out to us. But contract the property, do your inspection, do your due diligence, work with your team, verify the information, get your financing in place, and close escrow usually 40, 45 days after you go to contract. And so that is the process. It's not that complicated, but believe me, once you've done this 2 or 3 times, it'll become like, I don't know, maybe riding a bike. Maybe not that simple, but riding a bike. But in just wrapping up here, decide what kind of investor you are. There's really 2 types of investors, and this is the reason I titled the podcast the way I did. You're either an active investor or you're a passive investor. If you're an active real estate investor, you're going to roll up your sleeves. You're going to be involved in the acquisition. You're going to be involved in the renovation. You're going to be involved maybe in the management. You're going to be involved in parts of it. Or you could choose to be a passive real estate investor, which means that you focus on your career, spend time with your family, do the things that you want to do, in your life, go to Johnny's soccer game on the weekends, but you're constantly investing. You're accumulating investment capital, and you're deploying it as quickly as you can. And your goal is to build as large of a portfolio as quickly as you can to meet your financial goals. And that, to me, is what passive real estate investing is all about. And that's what we focus on and what we talk about. But everybody's different. Some people do both, and I've done both, and I by far prefer passive investments, whether it's an apartment syndication, a fourplex, a single family home, whatever it is. I really prefer just to close escrow, cash flow from day one, hold that portfolio, and rinse and repeat. So, that's my preference. So just wrapping up, our ecosystem here is threefold. We are a nationwide provider of tenant-occupied turnkey rental properties. They're all professionally managed. Again, the idea of being turnkey is that you acquire and benefit from the cash flow. We're in 22 markets, which is more than I want to be in, but that changes from time to time depending on the changes in the markets, the inventory, the availability of good deals, the team in those markets that we can assemble. Those are all important factors. The private lending, we've kind of scaled back. This has kind of shifted from being note-oriented to being investments in real estate syndications and deals that involve development. So that's kind of something that's been in flux. And then thirdly, group investments. These are syndications, whether they be for apartments. We've got a couple of, believe it or not, cannabis-related real estate development projects on the go. Very heavy on the cash flow side, but they're still real estate. Everybody has to live and work somewhere, so everything is real estate related. But our core business is really the turnkey rental properties, single families, duplexes, fourplexes. So in wrapping up, the question is, what do you do next? There's a couple of freebies, if you will. First and foremost is the Ultimate Guide to Passive Real Estate Investing. This is a free download. Available on both our websites, noradarealestate.com and the Passive Real Estate Investing website. It's a 40-some page document. It's basically a primer. It's everything I just talked about and then some, but it's a great mini book for you. Now, this is being turned into a full-fledged book called Passive Real Estate Investing, titled after the podcast. It's not available yet. It's done. It's in manuscript format, but it hasn't been released. It will be released here probably this first quarter. So if you subscribe to our newsletter, you'll be notified of it, and the day will come where it'll be released as a free book. So if you want a free copy, certainly sign up for it. And then lastly, as I mentioned a couple times here, I have a podcast I do weekly called Passive Real Estate Investing. You can find it on iTunes, Google Play, iHeartRadio, Stitcher, et cetera, et cetera. But anyway, feel free. It's free, so feel free to subscribe. And this is what it looks like on the screen. It's red, white, and black, just like our logo. So that's it. And I forgot to mention, if what I'm talking about intrigues you, you want to learn more, or if you think this is something that you want to take advantage of, just schedule a free strategy session with my team. We have 6 investment counselors. They're all investors. They're all senior people. And so we get this, and this is our philosophy: creating financial freedom for the sake of having time freedom and doing it through cash flowing rental property, whether it's a single family home, small apartment, fourplex. That's what it's all about. All right. I spoke very quickly because I wanted to fit all this in and leave a little time.
You did a great job. That was almost on the nose for 6 o'clock, and we got 15 minutes for questions.
All right, cool, Dan. That's great.
Well, I'll tee up some of these questions as we're going through. I don't think we'll have enough time to get to every single one of them. So if for some reason we don't get to your question, you can take it over to the MFIN forum, and Marco is on there as well, and he'll try to answer some of those questions if you tag him on the forum. But let's go with the first one here, which is, how do you keep tabs of so many markets, and what are your key sources for the information?
Okay, so a lot of this information is available on the internet for free. We do have some proprietary tools, and we also subscribe to some expensive data services to give us the data we need in order to map and chart what is going on in the market in terms of prices, momentum, if you understand the concept of technical analysis in the stock market world, these are some of the tools we use to see what is going on now, what has happened, and where things are going. So this is called, in the stock market world, they call it price action. It's the same concept in real estate. So that's the technical analysis side. The fundamental analysis side comes from a plethora of information out there in terms of you can go to a lot of websites for any city, and you can type in the city name followed by market data, like let's just say Kansas City real estate market, Kansas City real estate forecast. The government has websites such as, the statistics website, Department of Labor, what is it called? The DLS, Department of Labor and Statistics, I think is what it's called. Yeah. There's a bunch of free websites is the point I'm trying to make. If you just go to a search engine like Google and you start typing in the city name followed by keyword phrases related to employment, unemployment trends, new employers, economy, real estate cycle, real estate market. These are all phrases that you can put after the name of a city. You'll come up with a ton of information. So a lot of it's free. A lot of it's widely available. It's almost daily that you'll find this information posted. And then, of course, websites like Zillow. I don't put a lot of weight in Zillow, but they do have some good research and information on there. So, but yeah, at the end of the day, it's just a combination of tools and free and paid information.
So I have another question here. Before I ask that, I want to introduce the gentleman sitting next to me. It's our local multifamily real estate investor, Dakari Towns. You may have heard of him. He was on one of the podcasts with Joe Fairless recently. You can Google him on that, but he's joined us here. And question coming up here next, Marco, is, do you consider rent-to-income ratio important?
Are you referring to what I was talking about before, the rent-to-price or rent-to-value ratio?
I think it's more in line. I'm not really 100% sure, but I think it's more in line with the rent-to-income ratio of the tenant.
Well, yes, yes, it is important, of course, because you don't want to lease a unit or a property just to anybody. Most property managers are going to look at their income and then take a third of it or a certain percentage of it and say that is your allotment towards rent. So if they make 3,000 a month and their rent's 1,000 a month, they might fall within the criteria, the qualification criteria of that management. If you're self-managing your own property, you need to determine where you're going to draw the line. What is qualifying and what is not qualifying. If someone's income is not high enough, in other words, if the rent is making up 50% of a person's income, they're going to struggle, and they're also not going to be a long-term tenant because they're eventually going to get to a point where they are not happy with the amount of disposable and discretionary income that they have because it's all going towards rent and expenses, the car, gas, utilities, and groceries. And they're going to say after a year, this is too much, it's too expensive, and they're going to move. But if someone's only contributing 25-30% of their income towards their rent, it gives them a lot of breathing room, and the motivation to move is far less. So I don't know if I'm answering your question, but that's my answer.
Hey, Marco, this is Dakari again. So someone asked, how do they figure out the class of the neighborhood if they don't stay there?
Oh, okay. So the first thing I look at is the percent of owner-occupied homes in that neighborhood. The higher that is, this is just an oversimplified example. If it's 100% owner-occupied, that is clearly an A+ neighborhood. If it's below 50%, I would call that a C- and below. And so anything in between that is really just a gradient scale of how I would classify that at a high level. So that's the starting point of how I classify a neighborhood. That works reasonably well, but of course, there's always some nuances, and you have to look at, the types of schools in the area, how many schools there are, the types of schools, and the quality of those schools, and don't expect them to all be like 8, 9, and 10 out of 10. That is just not all that common unless you are in an A or A+ neighborhood. So put some perspective on this. The amount of crime and the type of crime, especially if it's violent crime, those are two things that are considerations. This is part science and part art. We have a formula or an algorithm that we use to calculate that on our site. But if you start looking at those types of things, and then even just talk to 1 to 3 property managers about an area you're looking at to invest in, and ask them, just say, I know it's subjective, and it could be a matter of opinion, but how would you grade this neighborhood on a letter scale from A+ to whatever to D? And you'll find that property managers will answer that pretty close to each other. That'll give you a pretty good idea as well. So those are just some ways to evaluate.
Okay, great. Thank you.
All right, so I have a couple of other questions that have come in here, and I know multiple questions have come in from the same person, so I'm going to kind of pick a couple of them down the line a little bit just to give everybody a little chance to have some questions answered here. One of them is coming in from Claire. How do you find out which states are landlord-friendly?
2 answers to that question. One is, again, using a search engine. You can do a Google search and you'll find a bunch of articles that answer that question. There really is a lot of information on that. Answer number 2 is, what day is it today? Thursday? By Monday, there's going to be a detailed article on our website, the noradarealestate.com website, that answers that very specifically. It'll actually look at all 50 states, and it'll answer your question very specifically, and compare all the states to each other. So I don't know if that helps, but and we'll email that out to everybody that's subscribed as well. So
another question coming in from I can't pronounce the name, but last name is Shaw. How do you find general contractors other than property management referrals? Finding good GC has been challenging in new markets.
You got that right. I pull my hair out with GCs.
Next question.
Yeah. Man, with any contractors, sometimes they're great and sometimes they're flaky, and sometimes they're great and they become flaky. You can go to websites like Angie's List, Yelp, and whatnot, and look at what people's comments are and their reputation online. Often it starts with you asking someone on your team for a referral, and then you do your due diligence on them and you look at their reputation. So you could talk to your property manager and just say, hey, I'm looking for a good general contractor. Can you recommend a couple of people? And take those names and just start there and then just do your due diligence. That's probably the faster way to go about it. You could do a Google search or a search engine search and find, some people, or just go to Angie's List or a place like that. But you're going to have to spend the time and do your due diligence on these people.
Great. And next question here is, if the goal is to build wealth long-term, would you recommend trading from bigger property to bigger property through a 1031 or refinancing properties, taking that cash to purchase the next property and holding each property long-term?
Okay, so I just saw the question you're reading. Is the goal to build, if the goal is to build long-term wealth, would you recommend trading from bigger property to bigger property through a 1031 or refinancing my properties? Taking the cash to, okay, well, this is a slightly complicated question because there's a lot of scenarios here. Actually, you just took the question away from me. You marked it as answered.
Sorry about that.
No, that's okay. So here's the thing. If you're looking to build wealth, okay, that's the word you used. It wasn't all about cash flow. What you're going to need to do is analyze the portfolio you have and see where you have a lot of equity. And a lot of times that equity will be dormant. And what you're going to do, and this applies whether it's a single family home, a duplex, fourplex, a 10 unit or 50 unit or 500 unit. These are all different. These properties all work a little differently in terms of how you grow the equity in the property and what affects that equity. But the principle is the same. If you have a lot of equity that's sitting there dormant, what you want to do is reposition that equity, whether you sell the property in 1031 or you strip equity out or you refinance to take some of that equity through a cash out refinance and deploy it into more property to grow your portfolio. That's really how you're going to accelerate your wealth creation. And part of that calculation, part of that formula comes down to where's the property located, what's going on in that market in terms of its ability to grow the equity in that property, and we're talking about appreciation here. And if it's a commercial property like a multi-unit, bigger than 4 units, and it's determined by the net operating income, then the question is, are you able to grow the value of that property? And if not, then you're kind of locked into whatever equity you have, unless you can increase the rents. And maybe it's the right time to take that equity out. See, this is kind of a complicated question, so it's not easy to answer it without looking into various other factors that play into the decision-making process. But it doesn't matter whether you're going from small to large or large to large properties. You've got to look at what do you have now? What do you foresee you're able to do in terms of growing that equity over the next 1 to 3 years? Some of it's been driven by market forces, and some of it's driven by your ability to increase the net operating income on an apartment. and really, you just have to analyze it every 6 to 12 months and just see, are you happy with where you're at, or can you grow it even further?
Well, now I have one last question for you, and then we'll wrap it up. So I know we have several other questions in here, but we can't answer all of them due to the time. We have about 2 minutes left till 6:15. Please stay till the closing remarks because I have something special that I want to do with everybody as far as sharing some of the golden nuggets that you learned throughout the first day. And so the last question here is about your the strategies that you use to build teams in non-local markets when you don't have actually a local presence in that market.
So to build your team, if you know somebody in that market, start with them and get some referrals. If you don't know anybody in that market, contact related people in that market, often contacting the property managers in that market will either become a person on your team, or at least a starting point, or they'll be able to refer some people that they know that are in the investment space, meaning they're real estate investors themselves. Real estate agents, real estate brokers are notorious for this. Most of them are not real estate investors. So you want to start with real estate agents or brokers, or a turnkey provider or turnkey promoter like our company is, in that market as a starting point to build your team, and then you bring on the rest of the people. Often what happens is if you find the right person, they'll often know the other right people that are related in the investment space to help you out. But it's going to be a little bit of work in the beginning, but as you go, you're going to find it's easier because you'll start to get connected to the right people on a faster and faster basis as you start to grow that network. Of course, you could always reach out to us. We can recommend some people in various markets for you as well.
Well, Marco, thank you so much. You were right on the dot there at 6:15. Thank you so much for coming in and sharing your knowledge with us and our group. And do you have any final closing remarks before you head away?
Thank you for your time. I appreciate the opportunity. And of course, for everyone here, just listen to the podcast and download the free resources I showed you just a few minutes ago.
Well, thank you so much, Marco. I appreciate you. And for those of you who are on with us still, I want you to stay tuned. We're going to be going through some of the golden nuggets that you guys learned from the day. And so I'm going to switch over some of the technology here and give me about 1 to 2 minutes, and we'll be back. So please don't go anywhere.